Welcome everyone. Good evening and welcome to Aeka's first webinar episode, the Mind Mingle. Today the topic for discussion is the future of fractional ownership with respect to real estate in particular. And I'm Vivek Mehrwade, so transaction and M&A deal advisor. I'll be the moderator for this session. We have a panel of 5 expert speakers who are here to throw some valuable insights on the trends and the opportunities in the fractional ownership space with respect to real estate. And of course, panel needs no introduction, but I'll take a tour and introduce you to everyone. We have Shesh Paplikar, who is the founder of BHIVE Alts. We have Sudarshan Lodha, who's the founder of Strata. We have Shiv Parekh, the founder and CEO of hBits. Anand, Narayanan, the founder of All DRX, and we have Abhishek Goenka, the founding partner of Aeka Advisors. So before we get into the context for today's discussion, I want to maybe spend a minute and share some perspective on how the fractional ownership sector today is looked at in the market. So when you say fractional ownership, it's simply owning part of the asset, right? So it's part of the whole asset that's owned. And the way at least it's been prevalent for a really long time. We've seen close knitted groups buying or co-owning assets. So we've seen friends and families and close investor groups owning assets. These are all conventional investors who had exposure to investing in real estate as an investment class. But today, with matured market, we also have platforms which bring us closer to the asset. They identify the asset, and they also get retail investors to invest in these assets. But I think there's still some perspective in the market where the conventional class of investors still look at it as a riskier portfolio or a product to be investing in, because when we say fractional ownership, it's basically collecting or pooling investments. So when you pool investment, there is an apprehension that these investments might go bust, or it's more of a scheme to get rich or scheme to pool money and siphon money somewhere. So that's a typical mindset, but I think slowly the industry is changing. So at this juncture, so Sudarshan, just want to get your perspective. What do you think the market is heading towards? So is there a change in the perception that the investors have, or is there still a lot of investor education that's pending?
Thank you, Abhishek, and thanks, Vivek, for having us. So I think we're still in the education phase. We're not there yet. I think the industry overall, all of us put together with other incumbents, should be about 5,000 crores overall, perhaps at the top end. So I think it's too small comparatively to what the size is respective. This is all built across 3-4 years, right? It's not that this is being transacted every year close to $1 billion. So having said that, there's still a lot of education, a lot of investors who are still on the fence, still dabbling with the idea, talking to friends and figuring out things, probably coming to you guys, asking for advice, what do you guys think about it, etc. Right? So I think we are still at the education phase, and I think probably with regulations, and we'll touch, as we move forward, this would become a much, I think regulation would take the education window in a large way, but still education is still a thing away. Like you said, it's not a scheme to become rich overnight. It's a stable long-term investment play in comparison. But having said that, we are at least 3-4 years away before it becomes an industry full-fledged. It's industry in the making right now, but a long way to go.
Great, that's good insight, Sudarshan. So, at least for our discussion today, we're talking about commercial real estate and rent-generating assets, right? So, Shesh, I have a question for you. So, you're in this space for a long time, and you provide co-working space, and you also have managed office space that you offer as service, right? So in terms of commercial real estate or demand, where do you see, globally, where are we in terms of commercial real estate and the demand for that? And how do you see India growing in the next 5 years? Because what we see is, there's a lot of demand, at least from the GCCs here. How would you rate India in terms of the demand in the next 5 years?
Cool. Thanks, Vivek. Of course, given we operate co-working space and managed office as well, which is a sister concern, BHIVE Workspace. While I think generally, if you would say commercial, I think there is growth in different areas. Office space is one of the segments. I think Sudarshan is an expert in warehouse, etc. I think that also has been a growing segment. So I think there are, I think various, of course, data centers, and there are various segments. So, and I'll be very honest, I think my expertise lies, whatever expertise I have lies mostly in the office space. While I know and I believe that whatever I would have read, key other segments are also growing. If I would limit my question more to office space, this has been growing quite well. And also the organized, the managed office or a co-working, or I think all of this put together is called flexible leasing, because within flexible leasing there are different segments between co-working and managed office. This is expected to grow. I think mostly the reports also suggest that at 30% per year it has to grow over next couple of years. And whatever trends we have seen does indicate that to us as well. I mean, one is whatever report says, one is what are we seeing at a ground level. I think it will have ups and downs. But I think amazing thing is that despite pandemic, I was in US also twice over the last few months. The way US is impacted is very different from how the same office space market in India is behaving. The impact of be it work from home, etc., is very different. India's population dynamics is also very different, right? India is still significantly young population. Whether it's pandemic, whether even in the current hybrid situation, if people who pass out from colleges, they still want to be in Bangalore, Delhi, Mumbai, etc., for their career opportunities. I don't think that migration trend has changed long term. So be it, I think Bangalore only, I think today I think house rentals are shooting up like crazy. Traffic is like also there, right? All of these are indicators that office space, sometimes there's a bit of a lag, houses getting sold. I think office space occupancy has not increased at the same rate as the way house rentals have increased. But I think that's a bit of a lag. But long term is really good in office space and managed office segment. And I think because of the India's population, I think this is true for other segment as well. Why would warehouse grow very well? Why would server space, etc., right, data centers, all of them is because of, I think on macro we are all very lucky that we are in a country that itself is going to do very well next 10 years. I think because of which there will be ups and downs, but overall many of the segments is definitely going to do well.
Yeah, so completely echo your views, Shesh, because even if we look at the recent REIT disclosures, right, the quarterly reports, the demand for office space has just shot up, and you rightly mentioned the demand again for office space and also other commercial assets in terms of warehousing, data centers has gone up significantly. And so, why we know there's a lot of demand, Sudarshan. So why aren't developers today looking at their exit strategy as why isn't fractional ownership structure one of their exit strategy to generate liquidity? Why do they still look to players like y'all to generate liquidity for them, or P funds or REITs to exit? So this could be a channel for them to exit, right? So there's just a question I'm really curious to know the answer for.
Great. So I think let's segment the market into three segments. One is assets up to, let's say, $5 million. Then from $5 to $100 million segment, and beyond $100 million segment. So right now the plays that the large developers are in the $100 million plus segment. So they have all the large funds ready to back them, all the banks ready to give them the rates which no other person gets in the market, as well as NBFCs who are willing to continue backing them, right? So they don't need capital unless they are wanting to exponentially grow in general. And these large developers are with a 2-year, 2-decade, or a 3-decade pedigree, which they have. So obviously they have their bunch of investors who are obviously loyal and they continue backing to them on a regular basis, right? So and their need for capital is comparatively lower in general, and hence their expectations of pricing are also obnoxiously very high, which is very difficult for us to consider matching. Then comes the second, or let me take to the third segment first, which is assets less than, let's say, $3-4 million or $5 million. So these are those segments which banks are also not funding, do not have the kind of leasing capability. They are usually doing 1 or 2 buildings a year as such. So they also have their own difficulties in leasing and understanding the quality of development, etc. Again, they go to these HNI investors at the end of the day who try putting into it, generic issues with respect to them understanding the know-how. It's not just, I have Zameen, I have a land and I develop something and it should get leased out. Yes, in CBD locations, let's say if you're in Bangalore, in Indiranagar, Koramangala, it's a different math. But, when you look at the way what a Prestige or a Brigade or a Salarpur thinks is much different comparatively, right? It's giving the whole park experience and bunch of other things around the same. Then comes the mid-tier segment, right? Which is the segment which ideally are the place where we are all playing. per se, right? So that is a segment which is opening up. Capital, these are those people who are getting capital, but not as much as the big boys are getting. They don't have that kind of sales velocity or leasing velocity the way big boys are getting, but they are far better than the third layer which we're talking about, right? So this segment is the more to be professional or to be the next embassy or the next prestige or the next punch shield for that matter, right? So these are the guys who are wanting to work, because for these large funds, this is too small a play for them to consider as well. And that is a segment which is opening in a large way, and that's the kind of AUMs which we can build. On the other hand, very interesting point is for these larger, the first category, right? Now, obviously, they sell their inventory to a lot of their investors or the funds, etc. So many who want to exit from that are the ones who are also reaching out and saying, why don't I work with you as well? So it's not a direct developer relationship, but the developer probably sold it to an investor, and the investor wants an exit. They are reaching out very proactively and looking at trades as such. But from the developer, at the prices which we want to buy, which ideally should be the market price, to what an HNI who just wants to dump money and get security of capital. Unfortunately, we are not able to, meet those pricing, because of which the large developers are keeping us as a second option.
So if I understand this right, so Sudarshan, what you're saying is it's a wholesome exit that these developers look at with a better cap rate that HNI could give them, vis-a-vis, the kind of market that we are trying to tap. Because for us, it's the retail investors that we're looking at, and not someone who could give us a 7 or 6% cap rate on our investments.
Perfect.
So, so Abhishek, I have a question for you here, because, what we understand is there's a lot of scope, there is demand for commercial office space, and also we know that there is this mid-tier market which can be tapped, and that, there's a lot of vacuum there. What are the kind of structures that you've seen, in terms of fractional ownership? What kind of structures are implemented today, and what is the investor's go-to structure when we talk of fractional ownership typically? And again, the follow-up to that is,
ideally,
do these cater to all sort of investors, or each structure is aligned to a specific investor or a category of investor? And do these also help HNIs and NRIs to invest?
Sure. So Vivek, actually at a headline level, I would say there's too much structure, and that structure is really the friction in, the fractional market growing, right? I think we need to destructure this. So, it may, I don't think that's going to be less business. In fact, more regulation, more clarity, easier structures are always better for everyone in the ecosystem. Because, today we're trying to retrofit structures for a sort of segment or an investment opportunity for which you need a much more easy in and out structure. Commonly today, you'll see companies where you'll issue CCDs to the investors. You're doing that because you can't raise debt from sort of random people. That becomes a deposit. You have to then educate a retail investor what is a CCD. You have to then educate them what is the flow of money that they will get. You have to educate them, do they have voting rights? And all of these things work well when the market is going in one direction, right? The fear I have with these structures is that in any market, there are going to be, as Shesh also says, ups and downs, right? Now, the moment there is some leasing pressure, there is some leasing vacancy, there is, let's say, God forbid, some title issue in a particular asset, all of these structures will start coming apart, because then the ability to exit, the ability to get capital back becomes very, very expensive. We've also seen how the regulators have clamped down to some extent on the LLP structure. And that's again quite unworkable, because every time somebody needs to transact, you need all partners to sign. And then you have this whole limit of 200 people in a particular company or even in an LLP. So if you're looking at a large asset acquisition, to Sudarshan's point, that there are several large opportunities in the market today, but then because of the investor limit, you get stuck. So honestly, I don't even think that the current structures should really be perpetuated. I think we need a lot more ease of operation. I know the government has its own constraints in trying to indirectly control any sort of crowdfunding type of fundraisers. They have a fairly high threshold for AIFs. But I think they need to really realize that fractional real estate is going to be the game changer. Democratizing it is how they need to look at it. In fact, I think we should stop using the word fractional, because there is nothing fractional about it. It gives a sort of negative impact, and I don't know if everyone agrees. So yeah, so I think we really need a lot more simplicity, and we need to stop trying to retrofit existing models into this burgeoning opportunity.
So, Abhishek, are these platforms also, so are these available to NRIs, and can non-residents also pick up ownership, not fractional, of course, ownership in the asset?
Yeah, so there are some rules. See, I think in general, Vivek, non-residents can buy real estate in India. And again, when we say non-resident, this is a non-resident Indians. There are some limitations on buying agricultural kind of land and those projects, but otherwise they can. But that is where, again, these structures create friction, because while they can own assets directly, there are limitations for them on, acquiring listed NCDs. And, to some extent, if you're raising foreign capital in the CCD structure, then there are lock-in conditions. So, I think we need to distinguish between institutional structures and sort of democratic structures. And I think subject to some checks and balances and controls, the whole philosophy needs to be different. Right now, we're trying to, interpose a structure where a $20 billion fund acquires an asset and use the same model for 20 investors to buy a $1 million asset.
Perfect. So, Abhishek, so then, these structures are the ones creating complexity in the market and for the investor. But what Anand's doing is very different. So, Anand, why don't you talk about, what you're doing, and, what tokenizing real estate really mean, and, what's the underlying asset that you're looking at in terms of, are these commercial real estate, are these residential, are these other rent generating assets? So, would like to understand more from you, Anand, on what you're doing, because what Abhishek's trying to suggest is that these structures are creating complexity, and what you're doing is something similar, but you don't have a structure which is as complex. But I want to hear from you, what is it that you're offering?
Yeah, thanks, Vivek. I mean, thanks for having me over. I mean, I'm the odd man out here in a bunch of senior pros who all believe in commercial real estate. My business is different from the perspective that it's built on two premises. One is who I want to serve, and my lack of conviction on office assets, and hence what I have done is I want to serve middle India, what Sudarshan, Shesh, and Shiv want to do is probably serve the affluent Indians, right? So they, in banking parlance, they are building private banking businesses for using real estate as an offering. And I'm building a retail banking business, So I'm opening Jandan accounts, that's the parlance that I want to draw in, So because of the fact that I'm serving middle India, which means their ability to comprehend structures are far limited, so hence there's a requirement for me to give fairly straightforward basic products, so I don't sell my products based on return. So I very little is spoken about 18%, 16% return. That's not the piece. So I am the fundamental piece that we are servicing, the easiest way to own real estate going forward, the safest way to own real estate going forward. So hence that piece I believe is resi. Everybody understands residential. So we've all grown to the stories of our parents and grandparents saying that, listen, I bought a piece of land and it grew 10 times. I bought a piece of apartment and then it grew 5 times in volume. Very few people have said that I bought an office space and I became wealthy, right? That's not the stories that the middle India has grown with, So I am ensuring that residential assets can be bought by middle India. Anybody can purchase residential assets. How do I bring in liquidity into that business? How do I ensure that I can bring in diversification into that business? Why should one put in, let's say, all the life savings, a crore into a single apartment, single location, single developer, one tower, one floor? That level of concentration is not required. That's the piece that we are trying to solve. Within which, with resi being the underlying anchor assets, we are saying already there could be various utilization of assets, which means it could be a residential for a family, it could be a residential for a senior person, which means it's a retirement home, it could be a hostel, it could be a service apartment, it could be a holiday home, it could be developed plotted lands, So various kinds of assets, as long as the fulcrum remains to be resi. And resi is far more liquid. It's possibly, it can't deliver the kind of alpha that commercial possibly can if you choose the right commercial real estate. Resi might not be able to give that kind of return, but then the safety, the liquidity that it offers especially to Middle India, is far greater, and that's the piece that I want to do. So
How are you
fundamentally,
democratizing
people,
this, Anand? So in other terms, how are you offering this to general public? How are you democratizing this? How is the ownership getting passed on to investors, and what form of token do they hold to get ownership over the asset?
yeah. So I mean, so the piece that I've learned all my life is the moment you're servicing Middle India, you can't become very complicated. The structure could be extremely complicated. So if you start lifting the hood and seeing how your car is done, you can never sell a car, right? You should sell a car based on how it looks and who manufactures it. So the proposition is very simple. You can buy and sell real estate 1 square foot at a time. That's the simple proposition.
Perfect.
You can buy 10 square foot today, sell 5 square foot tomorrow. The instrument that we are creating is a digital asset. It rides on this fact that it's a tradable digital asset. For the first time in India, these assets are stamp duty paid, legally enforceable contracts on the underlying cash flow of an asset, which is what a debt is, right? It's not an NCDs also is, The beauty is it's tradable. Okay, so you can, instead of, let's say a person puts in 10 lakhs, instead of him getting a single NCD certificate for 10 lakhs, here one would possibly get 100 NCD certificates. I'm giving an NCD as an example here, 100 tokens of a face value of 10,000 rupees each. So it's 10 lakhs is broken into 100 certificates of 10,000 rupees each, thereby giving him the ability tomorrow to say, all right, I may sell 10 at any point of time, So that's the piece that is getting done. So across the world, the path that fractional real estate taking is twofold. One is the path that the likes of Sudarshan, Shiv, and Shesh are doing, which is an SPV owning the structure, and it's a fairly close-ended, self-liquidating structure. At the end of 5 years, you sell the real estate and distribute the money back. Whereas the platform that we are doing is a perpetual vehicle. It's more like a REIT. The assets are not sold; the assets are held in near perpetuity, which means there is a requirement for a secondary sale platform to give liquidity. So the tokens are then hence used to give liquidity for people to move out of it when and
Very interesting point, and so I'll hold on to that liquidity aspect that you touched upon. I'll come back to you with further questions on that. This is really interesting, and I have more follow-on questions for you on this. But for now, Shiv, so we spoke about the demand, we spoke about the supply, we also spoke about structures that are there for fractional ownership or ownership in real estate, so to say. And also, Anand just mentioned that how is he differentiating our typical fractional structures from what he's offering in terms of tokens to the investors. Now, for any of these structures to be robust and to be success, right? So what are the key ingredients that you see a fractional structure should have? So, be it, should we look at, the category or the class of asset? Are we focused only on the grade of asset that we are acquiring and offering to investors? Or is it dependent solely on the leasing ability the leasing manager has? Or are we looking at, what are the aspects that we consider here, or the length of leasing that we have with tenants, or the grade of tenants? What adds to the success of fractional structures?
No, I think firstly, just great to be here, Vivek. Thanks for having me. Thanks, Abhishek. Thanks to all the panelists. So I think I think the real estate that you're investing in ultimately is the most important part, right? And I'd say in that real estate strategy, there are 3 major heads to that. One is your real estate acquisition strategy, other is your real estate management strategy, and then your exit strategy. So in terms of, and you can't say that, okay, one is more important than the other. All 3 of them are equally important. In terms of, your acquisition strategy, there are a few parameters that, we as a platform find, very, very important and very, very paramount. And those encompass kind of, all the things that you mentioned and more than that, right? One is the grade of the asset, and, going deep into the quality of construction, the kind of BMS in the building, what kind of elevators have been used, because you really want to establish what the longevity of that building is, and is it going to be a competitive product, as time goes by. So that's number 1. Number 2 is the micro market that you're getting into. Is that micro market within that city going to be an attractive micro market going forward? What is the occupancy and vacancy today? What is the upcoming supply? And how do we expect that micro market to fare within the dynamics of that specific city? Other, obviously, like you mentioned, is the quality of the tenant. Ultimately, in the platforms that we have where, investors are investing, based on the contract or the rental agreement that's there between the tenant and the landlord. So one, you want to check the background of the tenant, make sure they have a strong balance sheet, look at the payment history of the tenant to ensure that it's coming on time, look at the lock-in on the contract, and multiple other clauses that go into a leave-in license agreement, the notice period, your default clauses. And then what's important to look at in terms of pricing and rental is to make sure that your rental and capital value is below the micro market average, right? Just to give an example, if your rental, the market rental is 100 and you get in at 80, then even if the tenant leaves, you're able to release it.
Yeah.
So this is kind of falls under the gamut of commercial diligence. Then there's obviously the technical diligence that needs to be done in terms of approvals to make sure everything is above board. And then the legal diligence, which we obviously work, and most people work with tier 1 law firms to ensure that the top legal diligence is done. So there's no title issue or title risk on that property. So entry obviously becomes very important, meeting all these parameters and then ensuring that you enter at the right price becomes, extremely important. But it's not good enough, right? Then you need to manage the asset. And in terms of managing the asset, I'd say there are two heads again. One is facility management and other is lease management. In terms of facility management, if you acquire a unit within a building, then you generally pay your CAM to the society and hopefully ensure that there's a good facility manager in place. And even if a fractional platform acquires a full building, most likely you'd outsource it to an IPC, whether it's a JLL or a Cushman. But the real crux, the important part is your lease management, ensuring rental collection is on time, ensuring you service the tenant in a way that the tenants wants to stay in that asset for the long term. And there will be certain cases where the tenant needs to leave for various reasons. So having that ability, ensuring that the fractional platform that you're going with has the ability to release that property. And that comes with, having relationships with HR heads, admin heads of a lot of these MNCs with IPCs to be able to release the property. And to be honest, if you do number 1 and number 2 right, then in 4 to 6 years, when you're looking to exit the full asset, you've ensured that you're able to exit an asset at the right price and make good returns for all the investors. So I'd say these are the kind of the 3 overarching heads, to ensure that ultimately you're making a good real estate buy.
Perfect. So I have the best grade of asset, I have the best leasing managers. I also manage the property well so that I have a better NOI and my exit cap rates are always better. So great. So Shiv, this really helps because when we talk to investors and also when we kind of evaluate structures, these are the kind of questions we get from our investors because what is it that needs to be considered, because you have the regular cash flows that they receive and also the terminal value at exit, right? So what is it important? Is it the grade of asset, or do we rely on the leasing, or do we rely on the client whom they've onboarded on the premise? So these are the aspects that even we evaluate. So with this, Shesh, I have a very interesting question for you. So let's say you identified an asset and now you want to offer ownership of that asset to investors. And do you think running the asset under a particular brand unlocks better value, and does it trump all the aspects that Shiv just mentioned? I'll just give you an example or context to where I'm coming from. So let's take Starbucks, for instance. We go to Starbucks, it could be anywhere in the country, and the quality of service is standardized, the pricing is standardized, and what you can expect there is very standard. So therefore, do you think managing an asset under a brand kind of has an edge over other structures and other platforms? How do you see, in terms of investor return, is this something that they should look out for?
Yeah, thanks, Vivek. I think that's a good question. I think, in my view, ultimately the yield is dependent on what is the end, who is the tenant or user, each people, right? What are they going to pay? And I think across multiple segment, right? Look from a residential, everywhere, I think the brand has its value. And I think, brand is not just brand, right? Brand has been built by giving consistent service. And there is somebody out there to defend the brand by maintaining the reputation, by giving that service. So if I would buy an apartment, a Prestige or a Sattva or a Shobha, there is a certain value, right? Whereas I've seen that, some of my own friends and, family who have bought apartments which are non-branded, when they try to rent, it has been difficult. That means the yield has been challenging. When they try to sell, I know people from years together, it's been difficult to sell. Whereas, I live in a Sattva property. I know that the ability to rent it, I don't own it, I know I myself am a tenant, but I see that the ability to rent it out is very good for landlords, and ability to sell and whatever trading is very good. I think that kind of goes across for many things. Especially, let's say I look at office space segment or a commercial real estate, right? That can become office sometimes. The property I pick up can become Starbucks also. The warm shell can sometimes become retail as well, based on where it is, right? So what happens is a lot of times, tier 2 or there are, of course, there are a lot of builders out there who are not necessarily branded. They sometimes, they may end up building a really good property, but they may not have the leasing expertise. They don't have the brand. So I think a lot of times the long-term yield of the property does drop and does not achieve the same potential. That same thing, the same reason explains why when a Blackstone also buys properties, they can turn it around because they come with an expertise. They kind of would do a spreadsheet, do market analysis. What a small builder can never ever do that, right? And where should it be? It might the segmentation where it is position itself may be wrong. That the builder has a larger expertise in acquiring land. The whole process of building is so different than ultimately leasing and generating yield, right? They are two different things. So I think Blackstone, etc., understands it well, and they're able to generate much higher yield. Same thing, somebody like a BHIVE would take up a building, and we also usually take up and taking up large buildings. And typically, we are specialized in mostly, like, out of our 24 properties, 23, only one of them is with a major branded player. 23 are actually unbranded, you can say. That is where we have seen the highest value, because we are able to put our brand, we're able to get it at a good price, and ultimately able to generate significant value out of it. So I think end customer does value it in across the segment, be it residential, be it commercial, retail, everywhere. I think hotel as well, right? When there is a brand, I'm willing to pay that price, right? If something is like a Ganesha Lodge, I'm already like, boss, I don't know, right? So I think that's true. And I think, and also construction and building is very different from ability to rent and generate yield. I think if they can be decoupled, there is definitely a lot of value.
Fair point, Shesh. I think, this is true in all segments, right? Like you mentioned. So wherever you go, I think brand does matter, and brand can get you the vanity or the upside that you need. So, we did discuss about, the entry points. We did discuss about the demand for in this space and the investor mindset. My next obvious question will be on the exit strategy, and, Shiv, I have a question for you there. But before that, Abhishek, I have one question for you. So, from an investor standpoint, right? If I were to look at purely from an investor standpoint, what would your expectation be as an investor from fractional ownership? Would you only look at the return that you get from your investment in terms of monetary benefit that you receive, or would you also want this to be coupled with, let's say, time sharing or access to the property itself? So conventionally, if someone co-owned the asset, they have access to the asset. They can go sit there. They can maybe establish something there. But in our context, it's only return on investments that you're looking at. So as an investor, would you want this to be coupled with a timeshare or access to the property?
So Vivek, in my opinion, there are sort of three very distinct models, and actually, I don't think anyone should confuse these models or try and mix these models, either from an offering perspective, nor should investors try and mix and match, right? So I think the fundamental concept is an investment-based approach, which is to say that, would I look at real estate as an investment? And how can I now do it in a more democratized way without having to, as Anand said, buy only one apartment in one building? The second model is totally ownership and use based, where there is absolutely no return. It is just joint ownership of a holiday home or whatever it is, and X number of people share it across the period of time. And of course, their platform helps in managing that, and then the services and all of that. And then you have a kind of third model, which is somewhere in between, where of course there is a return, because there are people who are building these holiday homes, they manage it for you, they put it out for rent to third parties. So that is, I think, the best of both worlds. But obviously the ticket sizes there are somewhat larger. Those are not necessarily fractional. They expect one person to buy it, although there's no reason why that can't be democratized as well. So I think it's important that all of these three flourish in the market. Obviously, when it comes to the commercial aspect, and maybe Shesh has a different perspective on it, but normally, if you're buying in a commercial office space, there's no expectation that you would use it yourself. That obviously changes if you're looking at a holiday home. Similarly, if it's a sort of main home or a residence that can't be shared. So I think it all mix and match, and I think there's a huge market for all offerings today, because just like Anand is going after the middle India and the retail market, the kind of liquidity we're seeing with HNIs is unparalleled, never seen before, and the kind of offerings that the Stravas of the world are doing and how fast those are selling out is just unparalleled.
Perfect. So I mean, this helps, Abhishek. So this compartmentalize at least, what investor need to expect and what is the return out of it, because ownership doesn't mean you necessarily get ownership on the asset. I mean, it's from a distance, of course, but what you can expect is a return from that investment, but not direct access to the asset per se. Now coming to the exit part of this shift, so I want to understand from you, sir, how liquid are these investments, and also in terms of entry we have figured now, but in terms of exit, there's still some gap, in my opinion. And when we talk about these regular yields that we pay to our investors, that anyway is tacked to the rental income that the asset can generate. What about the capital appreciation? How do we unlock this? How do we realize the capital appreciation? Do we recycle these assets at the end of the investment tenure to a fresh set of investors again? Or do we sell these to other buyers, like a complete third-party fund, and then generate liquidity for these guys? How does it work?
Yeah, so let me touch upon the two ways generally one investor can exit. Right, one is the asset runs its life cycle or the investment horizon that we had envisioned, which mostly I think for most fractional players it's anywhere from 4 to 8 years, depending on the specific asset. At which point the fractional player will go into the market, solicit a buyer for that full SPV and the property. Go back to the investors. I think most players have 75% investors agree, and then the asset is sold to the new buyer. Your question of whether you can cycle the same asset to a fresh set of investors, I think obviously that's possible. We have to be done at arm's length, and what makes it sure that it's done at arm's length is the fact that ultimately it's the the current investors who are deciding whether they want to exit to a third party buyer or to the new investors that are coming in. So that's one way to exit. And generally over a long horizon, real estate has seen capital appreciation. When traditionally in these assets at a base case, you can see 5% year on year capital appreciation, then it can go higher depending on the micro market in the asset. The other is obviously, investors can exit their share on the platform at any point in time that they want. So far, I mean, I'd say it's obviously not as liquid as the stock market is. You can't, want to sell and exit tomorrow, but given 30, 45, max 60 days, and we've at least experienced that investors are able to get their exit. And the beauty of it is that as the industry grows, as there are more fractional players that come in, as there are more investors who become aware of this product, the liquidity is just going to grow. It's just going to increase further and further. The pricing at which investors exit at on the platform, generally, I think most players provide annual or semi-annual valuation reports to give some guidance as to the price of the asset. But ultimately, it's up to the investor to exit on the platform. So if the investor wants to be more aggressive, then he or she may try for a 10% premium to the market value. Might be able to exit to a buyer who wants to get in. If the investor is desperate, we had situations where emergency is required, and the investor might, take a slight discount and exit to a buyer. So that depends on the scenario. So really, it's creating the market for this. And I know we're going to touch upon this later, but I think the structure that's envisioned by the regulator really allows this, the liquidity to happen in a much more streamlined and smoother way. One, that they're reducing the ticket size. They're proposing to reduce the ticket size. And other is, I think your question of, and because the structure is just units of a trust, it becomes significantly easier to trade. And finally, I think your point of recycling the investors, I think the regulator probably envisions that happening to a much later basis, and then the asset never needs to exit the trust. So that's something that eventually I think most players would want to move towards. Because if you're picking up a good asset, then you don't want to, because each investor has a different investment horizon. So ultimately, you want to build it so that each investor can decide based on his or her own requirement, because the asset itself is great once you decided to enter it.
So is that how the mark-to-market would work, Shiv, in your view, if you were to, maybe regulate this, and if you were to make this a little more open to general public to trade and acquire
Yeah,
these
see, I
units?
think there are two. See, exactly. So on the tradability, I think there are two factors, right, to figure out the pricing. One is providing regular guidance through third-party valuers as to benchmarking the right price for the asset to figure out the NAV or the net asset value. But second, ultimately leaving it up to the creating a bid-ask mechanism that's there for your normal shares. And ultimately, I think that is what we're moving towards with the new regulation that's proposed.
So, we definitely will talk more about the regulations, and, I'll request Sudarshan to weigh in his views there. But Anand, before we get into the next part of the, discussion, I want to understand from you, you touched upon, your offering being similar to REIT. So do you think, what you're offering today, where you're tokenizing investment in real estate, can that solve the liquidity issue for investors in, conventional market where they're acquiring assets or co-owning assets? And also, the other aspect is, do you think that bridge between, owning REIT units and owning tokens can be converged?
So Vivek, fundamentally, the exit event or the timing of the exit needs to be investor-driven rather than manager-driven. In a close-ended structure, the exits are manager-driven, so the manager needs to make a carry. So you have to close the thing because you need to make a carry. So let's sell the asset and churn the capital out. But listen, I mean, like Shiv said, right? If I'm very happy with the underlying asset, I don't want to exit. But the problem is because the underlying real estate is being exited, everybody gets dragged along, right? So I think one needs to choose a path in your structure. You need to choose a path. Is your exit going to be investor-led or is the exit going to be manager-led? So I believe it needs to be investor-led. If I put in money, I decide when I want to exit. If I'm happy, I continue. If I'm not happy, I should be able to sell it. So hence a perpetual structure, which is like the capital markets, right? You invest and you decide when you want to exit. So I think overall there are going to be various capital markets that are going to emerge, right? Public markets are going to emerge. Public markets have emerged for equities in the form of stock exchanges. They have emerged for commodities in the form of commodity exchanges. There are energy exchanges, there are bullion exchanges, there are crypto exchanges. You don't get a crypto being traded in a stock exchange. You don't get a commodity future contracts being traded in a stock exchange or vice versa. That's because public markets are very siloed. So investor, when he goes into a crypto exchange, he knows the underlying rights and obligations. He knows the underlying risk class. Similarly, when he goes into a stock exchange, he believes in the underlying instrument that he's purchasing into is equity. Which means it should deliver 10 percentage points higher than fixed income asset classes. It can lose value. Imagine
what you're proposing is a platform to trade only real estate asset in that case?
That is what is required. You can't take a REIT instrument. This is my personal opinion. The lack of public markets for real estate, REITs are getting traded in stock exchanges. But how can you compare? REIT is a fairly safe, there's no principal risk. It's a fairly consistent return product. And you're going to compare it with a small cap stock that is listed in the same public markets or a large cap stock. So I believe there needs to be separate public markets that needs to be created for real estate backed instruments. You may call it by whatever name. You can call it a real estate exchange, like the way that I'm call it by whatever name it is. And those public markets are emerging in various methods. One is traditional stock exchanges. Another one are alternate trading terminals. Today there are regs in SEC, today there are regs in BIFC, there are regs forming in our own gift city. Where there are alternate trading terminals that are emerging for new asset classes. That's the piece that we are trying to say, is create a structure where the exit event is investor-led and give them the opportunity to be able to sell a quantity of their choice at a price of their choice. The moment you break a 10 lakh investment into 100 instruments, he wants liquidity, he can sell 10. If 10 doesn't sell, 6 will sell. You have the ability to make market making. So that's the piece that is important, and it all stems from the fact who leads the exit event. The manager's motivation leads it, or the investor's requirement leads it.
Yeah, very interesting, Anand. So, hope we soon see this as a reality and we have an exchange dedicated exclusively to real estate. But, I think that's the wish list. But let's hope that happens reality as well. So before we get to the regulatory aspect of this, another question, Shiv, we did speak of exit strategies, right? So, what I believe is, you need to have a healthy debt mix for a better equity upside on equity return. We do see that REITs have, cheaper financing that happens where they can give a higher equity return to their investor in terms of, their distribution. So when you talk about our fractional structures here, what we currently have in the market, do you think there is scope for us to have debt and equity mix between, us offering the asset to the investor and also have the ability to raise LRD or a cheaper finance within the entity so that our distribution goes up or the terminal value for the investor goes up?
Yeah, see, I think that depends
And
on the.
Sudarshan, sorry, you can weigh in here if you've encountered similar situation. Yeah, sure, please.
I think what we've seen, at least with our investor set, and I think it depends investor set to investor set, that majority of our investor set appreciates the monthly rental income that's coming into their bank account. They like the combination of, monthly income as well as then the appreciation that comes with. So yes, a debt might increase your overall IRR, but your monthly income would then go into paying the debt, right, or servicing the interest. And if it's a LRD, then the interest plus principal of that debt. So for the most part, we've not seen that, the investors that we do want that, although there are certain segment of investors who would like a leverage. So what we are working on is, rather than putting an LRD against the property, if one could leverage the shares and CCDs, and have effectively a loan against shares that's backed by the rental income that's coming in. That's something that we're working on structuring, in which case, again, it comes down to each investor preference. So then the investors that want to leverage are able to, and the investors are not able to. And then again, I know you're going to come to the regulation point, but at least in the consultation paper that was put out, debt was not permitted. But I think it was silent on the units of the trust, whether those can be leveraged or not, because ultimately that's up to the investors. And I think that's fine if, there's a structure where, banking or financing partners can give leverage to the investors on the units of the trust. I think that would, then you're able to leverage to the amount that you want to. So if an investor wants no leverage, it's 0%. If someone wants 20%, it's 20%. Because otherwise it's multiple investors, and having deciding the leverage for all the investors becomes very challenging.
True. Sudarshan, you have views here?
Yeah, so
and it's coupled with regulations, so I thought it's best to hear from you.
No, of course. So I think it's let me take Abhishek as an example in this room, right? So Abhishek has two different types of wallet share. One where he likes the rental income, etc., but at the same time he also wants to create that wealth. But now problem with Abhishek is, okay, cool, I get my monthly rental income, but I'm in the 30 or a 40, 39% tax bracket. So Abhishek is bleeding as well, while monthly return hitting is great, but he's also bleeding. So, when you take debt, it's a tax efficient product in terms of how you could create value for yourself. And obviously the long-term capital gains reduces your tax liability substantially. With regulations, once it's listed, then it's at 10% vis-a-vis unlisted, which is 20%. So that's another advantage, an investor could probably make. So we see that the same investor has two wallet shares, two buckets, which he wants to deploy his capital per se. And there are investors who only like to play this. There are investors who only like to get monthly return as such, right? So it's, I think the debt structure is more for sophisticated, who know the play, who understand the game. And I think it's more for them rather than somebody who's the first timer in real estate investment in general.
Yep.
Has bought his house and is looking at a second real estate investment. For them, creating that rental income portfolio is a greater proposition initially. But as they move forward, it's like a journey, right? You start with by investing directly, then you have a PMS, then you have AIFs to deploy, and a bunch of other wealth managers who get in the journey. I think it's a similar journey. So as you understand the game, you understand the play, probably get more conviction with the asset manager who's driving the business for you, which goes to the call what Anand was mentioning. So sometimes you give the decision of exit to the investors, but when you take debt, the investors should give the decision on the asset manager when they should take an exit, because debt is a double-edged sword, right? It can do wonders for you. It can wipe out all the wealth you've created also. In a cyclical market as such. So that's the way. I think it's more for sophisticated investors who understand the risks associated with it, but it's a large opportunity. So we after after close to about 26, 27 properties, we said, okay, let's take a debt approach. So we did 2 debt transactions recently where we took LRD as well as construction financing in a particular trade. It was an overwhelming response from that stand. So while we were always on the fence, we said, let's do it, let's not do it, let's do it, let's not do it. There were times where we were very convinced to do it, and RBI then increased the rate, back 2022. So we're like, no, let's not do it because I think it's going to go on an upper end. So now that we see that there is some kind of a flattish approach, which we've been seeing for the longest, at least for a quarter or two, and we hopefully don't see it going forward. And probably a year from now, when it starts coming down, I think all our debt investments, which we have done right now, might do wonders in terms of the capital returns, which we get at.
So I think there's a lot of interest from Abhishek's wealth creation portfolio or his wallet in these assets. So Sudarshan, in terms of regulatory ecosystem, where do you think we currently stand? There was something on MSM REIT earlier, and there was also talks about private REIT in the past. So where are we currently in terms of regulations?
So the last which I know is they're regulating for sure, but they're thinking the way and form in which they want to regulate, because one is platforms like ours, but also at the same time the regulations. If you saw the consultation paper, it also opens for even developers to participate in that, right? So a lot of the things are probably suited for them. Some points are very suited for us. I think that is the discussion. I'm sure the regulators are also thinking, but at least what I know is they are regulating this industry, right? So that opens a much larger approach. So when I brought out initially also, right, education is still a very large aspect to do it. So even I think regulation would allow everyone to talk about it in a larger way. I think a lot of people talk about REITs today in the market. As such, hopefully they'll start talking about MSM REITs as well going forward, which would be a great thing. So regulation opens a Pandora box of opportunities, to be honest. Right from NRIs to foreign investors, everybody could start investing much easier. Exits or even trading through the REIT platform will become much easier, while everything is going to be routed to the stock exchange. I think it's a great wish list to have a separate exchange only for real estate, what Anand was mentioning. But if that does happen, it's a great opportunity. But having said that, in true sense, the ability for investors to invest with smaller ticket sizes, also at the same time, what Shiv was mentioning, the ability for them to lever their units, which today we are not doing because it's unlisted, so the banks are not taking calls, or even NBFCs were ready to take calls. That we had 3-4 NBFCs were very keen to participate. But at the cost what they're doing, it does not make economic sense for anyone to look at leveraging, right? So we see, even if it's a last play, loan against securities later, which is not as expensive in general, might be a great proposition for investors to consider without exiting their investment. And for a short term, 3 months, 6 months kind of a duration is a great play for investors. So we've been working very proactively with banks. We started our conversations with a couple of banks at product level as well right now, that as soon as regulations comes, we would like this product to be rolled out so that our investors can, pledge that and take some, liquidity out whenever they want for them. So again, advantages, the interest which they pay allows them to take deductions as well, right? So it's more like LRD / but unfortunately REITs cannot get LRDs as such, and banks can't give them things. So it's the NBFC arms of the banks who can give loan against securities as such. So that's what we are trying to see, what we can do best for them.
Perfect. So, Sudarshan, I hear there are a lot of opportunities here, but also, when this becomes reality, right? So, how different would this be from any other REIT? Because today, what investors looking at from this structure is to kind of tag his investment to a particular identified asset. So when you move this into an MSM REIT or a private REIT, it gets lost in a larger portfolio. So this is nothing different from a listed REIT. So how do you differentiate this market from a REIT investment then?
No, so Vivek, I'll correct you, right? That's exactly what the regulators have thought, that we don't want it to become a mutual fund again. We want direct stock investing. So while they give us a license, but every property is a separate listing in itself, and your returns are limited only to that particular property, vis-a-vis the current REIT, which is a mutual fund where, even if 1 or 2 doesn't do, which impacts your returns per se, right? And so that is what is a clear differentiation between this REIT and that REIT. But in terms of opportunities, it also unlocks tremendous amount of new real estate, which will come. Smaller developers who always aspire to unlock certain value would look at considering this REIT approach right now as an exiting, where they don't want to exit 100% but want some liquidity out, is a great opportunity. Again, typically an LRD which a developer or a landlord takes is anywhere between 50 to 60% tops, which you can get. NBFCs are ready to give 80% as last, right? So plus LTCG is, like I said, 10% vis-a-vis a 22%, which is there right now. So a lot of benefits, a lot of new real estate or new kind of real estate can get unlocked. Like we are very aggressive in industrial in general. Nobody has been able to unlock industrial assets in general in the past as well. I think the regulators will allow us to do it. Like I could then go to Hyundai and say, okay, you have a 600-acre park. Why don't you look at REITing out with me? Because we know for you're never going to leave, but at least that allows you to unlock tremendous amount of real estate value, which it possesses right now, and could use that for better R&D or for better expansion or XYZ things, right? So I'm just giving you examples, but there are ways and means of opportunities which we are very confident would open once regulation comes. So regulation is something we've been waiting for 3 years. I'm sure everybody ever since we started, because that's the common question we all get: are you regulated? What's happening? Who are regulating? Who's overseeing you? But having said that, with regulations, it's more opportunities which we foresee coming in our way.
Yeah, but listing each asset separately does lead to admin issues. But I think, from an investor standpoint, this is least we could do for them.
No, so when we met the regulators as well, one of the core points was compliance cost, right? Because that would eat away the margins either for us or for the investors, right? So we said compliance cost has to be the most minimal per se. So there's a very close, if you see, there's very close connect to how the angel funds have been categorized or has been created by the regulators. So this MSM is very similar, but I would say it's more a Cat 2 similar to a Cat 1 angel fund, but just that it's listed because there are regulations. That's my reading about the consultation paper, that the inspiration is more from this standpoint, that there is an opportunity for them to have more specific investments rather than the whole AIF giving a blended return.
So, Sudarshan, given the paucity of time, I have one last question on the regulatory bit. So, we are looking at REIT regulations or MSM regulations which govern commercial office space or commercial rent yielding office space. So, would there be regulation which would also then oversee or govern other asset classes? Is that expected to be rolled out, or is that a wish list that we have?
See, so for furniture, for equipment, etc., I think regulators have already rolled out the OPP license, but actually at a neck-breaking speed, to be honest, right? Because it, again, tremendous amount of value unlocking can happen, especially if EV is the way to go. I think OPP platforms can be the way to really build that infrastructure because of trying to bring capital into that segment otherwise, right? So other segments generally, so this is a point which is a challenge in general. Like, for instance, if somebody is working on democratizing holiday homes and there is one common REIT MSM which is given, let me go with the reading of the current consultation report, it looks like they just can't do their business at all, right? Because holiday homes are probably not as rent generating or XYZ. So, I think it'll evolve over a period of time. There would be amendments after amendments before they do it again. Otherwise, holiday segment, unless it's really a very large segment for them to consider saying, okay, let us put our time, which they should ideally respectively. But having said that, I think they'll start off with the commercial piece as a common license, common rules and regulations for all. And then probably the amendments or caveats would come for other asset classes in real estate in general as such. But it is going to take some time, because even for a regulator, it's about, okay, let me roll out a consultation with paper, get feedback. Then, okay, let's implement, understand the practicalities of how it is, and then probably keep amending, right? I mean, you see AIF regulations, they're getting amended every half yearly, quarter, or whatever it is, right? With new regulations, because the idea is to make the system more stronger to protect the investors' interest at the end of the day, right? So anything which is going to come is not going to be the end of it. It's probably the starting of it.
So, thanks, Sudarshan. So, maybe to just wrap this up, I would want your views on, where, in terms of global market, where are we currently, and, where do we see India heading to? And, there'll be a lot more players in this market, right? You will see a lot more players who will offer this as an investment product. what should investors be mindful of and what should they look out for? I know there's regulation aspect to it. They'll be regulated at some point of time, but in general, if you were to, maybe put in 2 bits to the investors, say these are the things I need to watch out for, and this is where we're heading towards, what would that be?
So I think it's now that the industry is evolved to some extent, it's great to look at the performance as well before you just taking a call. Like, okay, what are the calls taken by this person? What has been the strategy? How well are they performing? Everything can't be rosy all the time, right? So it's very important for you to understand. Like I said, education is very, very important. So it's only with more players coming in, more education happens at the end of it. But the way the industry is going, I mean, regulation is definitely a tipping point in terms of how it can scale up. I foresee that if today residential is part of everyone's portfolio, so will MSM REIT be a part of everyone's portfolio with time as they move forward as such. But from a global standpoint, it's a very evolved industry. A lot of consolidation has already happened in the US in the same industry. Multiple acquisitions have also happened. But India is very different. You can't always compare, how things work in the West will always work in India. Look at WeWork as an example. It did probably work the way it should have in the US, but India WeWork entity is doing fantastic. Last I heard, they were very profitable as well. So hence from that standpoint, it's our demographics are different, our thought processes are different, our banking structures are different over here. And hence, from that standpoint, we are far more solid. But from a 10-year mind progress, what Shesh was mentioning, that the next 10 years is for India. So a lot of real estate development is going to be the backbone of this development as such, right? Infrastructure and real estate itself. So infrastructure, governments are funding, governments are bringing a lot of the whole fractional roads through hBits and trying to unlock value from there. I think for other asset classes, platforms like ours would be one of the core reasons as well in terms of empowering the new India. In a long run, right? So China had a similar story. It was called under the whole WMP wealth management product, where a tremendous amount of real estate did get unlocked. And let's not go into what eventually happened because of the whole bond crisis, etc. But it opened. So it's about bringing capital which is available in India and moving into something which people always aspire to invest and have not been investing. Let's take residential itself. It's a $20-30 billion every year investment market and $20-30 billion end use market. If we even bring in 10 to 20% of that capital, I don't think so. We need foreign funds running around India to back developers. There's enough and more money sitting in India to continue backing, projects or any kind of new initiatives in general.
Thanks, Sudarshan. I really, hope that our viewers have some tangible, takeaways from this session, because there are a lot of questions and gaps in understanding of how the entire structure operates. And, I think, you guys have been fantastic and you've answered all the questions to the point. And I think these answers will definitely help our viewers to kind of unlock the full value from these investment products. Thank you once again. Thank you. Thank you, Abhishek, Shiv, Shesh, Sudarshan, Anand. Thank you all.
Thanks. Thank you. Thanks, everyone.
Thank you, guys.
Thanks all. It's a great session. Thank you so much.
Thank you.
Thank you.